Hey, what's going on everyone? My name is Aaron. So in today's video, we're going to be talking about the problem with the crowd and why blindly listening to others could quite possibly be the downfall when it comes to your investing. If you like the content, please leave a like on the video, subscribe to the channel, and let's get right into it. Okay, so when we talk about the idea of following the crowd, what we're really talking about is this idea of herd mentality, or the tendency to blindly follow other people and other people's decision making regardless of the rationality behind those decisions. So in other words, herd mentality is really this narrow-minded way of thinking where we do things that other people are doing simply because other people are doing it, not because we've actually thought about why they're doing it. So imagine a flock of sheep traveling across a grassy plain. So when the sheep move, similar to other animals, they move in a pack, a very tight pack, and all the sheep desire to be in the center of the pack. Now, why is that? It's because there's this perception of safety when you're within a group, and specifically when you're within the center of the group. So think about the sheep. If you're the sheep on the very outside of the pack, technically speaking, you're the most susceptible to the risk of an attacker, versus if you're the sheep in the middle of the pack. And this again has to do with this idea of pack mentality, moving within a group and the safety within a group. Now, I know what you're thinking, Aaron, why are you talking about sheep? It's not just about sheep. I guarantee you, this animalistic desire to be part of a group directly translates into the investing process, and it affects you as an investor. So think about it. We're constantly being bombarded day in and day out between YouTube, television, CNBC, social media, our friends or family. People are constantly bombarding us with different strategies, different tips, different investing advice, different ways of thinking. So due to human nature in this scary world of investing, we want to feel protected and feel approved of by other people, and that translates to how we actually invest our money. So as a result, we tend to invest in these popular ideas, right? These prevailing ideas that we've heard from our friends or family, from TV, ideas that align with the status quo or whatever the most popular at the time. Now, it's important to note, I'm not saying that listening to other people is wrong. In fact, listening to others is one of the most important parts when it comes to investing, because by listening to other people's perspectives and insights, you could gain more information and become a more well-rounded investor. But what I am saying is that by blindly listening to other people and not critically thinking about why you're investing in particular ways, that's when the problems can start arising. So this stems from this idea that just blindly following the herd and doing whatever the herd mentality is at the time could be quite dangerous, and this is for two major reasons. Number one, herd mentality prevents you from unlocking the true goal of the investing process, which is finding value where others don't. And number two, the herd isn't necessarily always right. Okay, so number one, finding value where others don't. This is the key idea behind becoming a successful investor. And as an investor, we have to use our competitive advantage, our informational advantages, to find value in companies that others don't necessarily see value in. So we can do this a number of different ways. Maybe we work in a particular industry, or we have a particular hobby or passion for a certain company or a certain stock. And what we can essentially do is use that increased knowledge we have about a particular industry or company to our advantage by finding companies that other people don't necessarily see the value in. Again, this is our informational edge. We have an edge over other people based off of our increased level of understanding about a particular industry. However, by nature of this process, what we're trying to do is, like we said, find companies other people don't value. And as a result, we're going to have to think against the herd, because think about it logically. If the herd mentality, the pack mentality, is we have to invest this way into these particular companies, well, if we're trying to find value where others don't, we're naturally going to be trying to find companies that the herd isn't necessarily looking at that given time. So to put it another way, we got to find areas of the stock market that aren't necessarily loved at that given time. We got to find those unloved companies, those unloved stocks where that value lies, but just not discovered yet. Now, this is a very contrarian and difficult way to invest, because again, we got to be thinking against what the pack is doing, what the herd is doing, and we got to be thinking in ways that other people aren't necessarily thinking in order to find that undiscovered value. So not only do we have to find these unloved companies, but then we got to go that extra step of actually investing our hard-earned money into these companies. Now, this is the particularly difficult part of the, contrarian anti-pack mentality mindset. Because remember, maybe you've identified, well, this company I think is going to do a lot better in the future. Maybe the pack or the herd isn't really into it right now, but I truly believe in this company long term. That's great, but then you got to put your money on the line. You have to actually invest your money into this particular company. Now, that's scary, because again, it's one thing just to think and believe this company is going to do well, but then you got to actually put your money on the line and invest that money. So this is exactly when the herd mentality starts to creep in and starts to make us question our investments, because since we're investing against whatever the group is doing, we have this idea that, oh, this is a little dangerous, this is a little risky, I'm deviating from what the rest of the group is doing, this might not necessarily be the best decision. That's what we think, because again, it's been ingrained in us over time that we have to follow the pack and follow the herd. And this is the most important thing to understand. It's honestly the most crucial part of today's video, is that when you're looking for those next massive gainers, the next Apple, the next Tesla, the next Amazon, this is what everybody wants to find. And they're out there, those stocks are out there, but you're not going to find them following whatever the general consensus is. You're not going to find them following the pack mentality and the herd mentality. You need to look against the grain. You need to look at what other people aren't looking at to find that undiscovered value. Remember, by the time the general consensus and the pack mentality idea is that, oh, this particular sector is safe and good, by that time, everybody's already rushed into that space and bid up the prices of the stock, and all that undiscovered value has vanished. Now think about it with Tesla stock. For years and years and years, Tesla stock traded sideways. Why? Well, the general consensus on Wall Street was that Tesla was a way overvalued tech company. They were a car company, but they really weren't going to be anything. That's what people thought. And over time, as the shorts eventually got squeezed out, the company proved themselves. They developed more cars. They began selling cars. People realized, and the general consensus became, Tesla is actually quite a legitimate company. And as a result, the stock price rose over time because more and more common people adopted that viewpoint. But now if you're investing in Tesla after it's already over 10x, it still may not necessarily be a bad investment, but a lot of that undiscovered value is gone because the pack mentality has shifted in favor of the stock. So again, in order to find these massive gainers in the future, we got to look against the grain. We got to look against what the herd is doing to find that undiscovered value. Okay, so number 2, the herd isn't necessarily always right. So this scares a lot of people, but it's really important to understand that the perception of safety we have when we're investing along the lines of what everybody else is doing, it's just that. It's a perception of safety. It's not true safety. So in other words, because so many people are congregating around one particular investment idea, there's this perception that the idea has to be safe because how could everybody be wrong? But again, it's just that perception. But if you look back through time, there's countless examples of when whatever the group was thinking, whatever the common consensus was on Wall Street, that ended up being wrong. So take, for instance, the 2000 internet bubble. So back in the year 2000, basically any tech stock was going to the moon. Didn't matter what the company was, didn't matter how profitable or successful they were. People were blindly buying the stock of these companies with the idea that, well, everyone else is doing it. These companies just go up, so I'm just going to make money. And that worked for a little bit until the bubble burst, as they all do, and all these companies came crashing down. Now, a few companies made it out and are still around today, but the vast majority of these companies people bought into ended up crashing back down to zero. And this is a prime example of the herd thinking one thing, right? The group thinking one thing that seemed like it was working and it seemed smart for a while until it wasn't. And by that point, it was already too late. And then in 2008, a very similar thing happened, but with real estate. Back in real estate, the idea was the herd mentality at the time, the consensus was that real estate keeps going up, so we should keep making loans. And as a result, bankers made loans to really unqualified individuals and ended up fueling this bubble within the housing industry. And once the bubble burst, a bunch of people got burned. But the idea behind this, again, is that the herd mentality in real estate was that, well, real estate only goes up. So as a result, there's no risk too large because at the end of the day, nothing bad could possibly happen. And again, that herd mentality ended up burning a lot of people. Now remember, I'm not saying we should always do the opposite of what the pack is doing or what the herd is doing, but what I am saying is that blindly following these groups, that can become a problem when the herd ends up being wrong. And remember, you can protect against this by always doing your own due diligence and your own research on an investment and never investing more than you can afford to lose. I hope you enjoyed today's video. Please go ahead and leave a like, subscribe to the channel, and I'll see you in the next one.